Welcome back to the channel. Today, we're diving into January's top 5 hot stocks with real upside potential. If you're looking to start 2026 strong and spot the right opportunities in the market, this video is for you. December saw some weakness in tech and AI stocks, and the headlines scream that the AI bubble had burst. But when we look at the actual numbers, earnings, and institutional flows, it tells a very different story. Money is still flowing into these markets. Analyst coverage is expanding, and institutions are buying. So if you're selling your AI or tech stocks right now, you might be making a mistake. Sure, profit taking makes sense, but the December correction can also be seen as a buying opportunity. Over the next few minutes, we'll walk you through 5 stocks that are positioned for upside this January, and we'll break down why each one could be worth your attention. Our first stock is Advanced Micro Devices, or AMD. AMD is extremely well positioned for 2026, especially in the AI and data center space. The company has been preparing for this moment with its MI450 line, which is their first rack-scale GPU solution for large-scale enterprise data centers. Until now, NVIDIA has dominated the hyperscale GPU market because of its ability to deliver high-performance solutions at scale. AMD's MI450 changes the game. It allows major hyperscalers like Google, Amazon, Microsoft, Oracle, and Meta to have more options, not just NVIDIA. Demand for GPUs is currently exceeding supply by roughly 10 to 1, so AMD can sell as many GPUs as it produces without impacting NVIDIA's outlook. And if you're wondering whether AMD is too late, early commitments from large data centers suggest otherwise. The MI450 is already being integrated into planning for new data centers, confirming its relevance in the hyperscale market. December saw some pullback in AMD's stock price, but this is primarily profit-taking and market consolidation. Technical support levels remain strong, and the stock is well-positioned to take off once the MI450 line is officially launched. Investors should view this period as an opportunity to position themselves ahead of what could be a major catalyst later this year. Next up is Micron Technology. Micron is another stock that signals the AI market is far from cooling down. Their recent December report showed record results across all segments, particularly in data center and cloud memory solutions. This is critical because every GPU, including those from NVIDIA and AMD, requires high bandwidth memory, or HBM, and Micron is a major supplier. Their guidance was strong, with revenue expectations roughly $4 billion above analyst estimates for the next quarter, showing robust growth. Margins are improving, and supply constraints are creating a natural pricing advantage. HBM memory is in short supply across the industry, which is expected to persist for several quarters, potentially extending into 2027. This creates a strong growth and profitability tailwind for Micron. From a competitive standpoint, Micron's HBM is considered superior in both capacity and performance. Despite competitors in the market, demand far exceeds supply, meaning Micron can continue to grow without losing pricing power. Analysts have adjusted their price targets, reflecting confidence that this strong trend will continue. Even though the stock has seen a strong run-up recently, the December pullback provides a potential entry point. Investors should consider that this is more than a short-term story. Micron is positioned for sustained growth in the AI-driven memory market. With strong earnings, guidance, and an ongoing supply-demand imbalance, it's hard to ignore the upside potential for 2026. Moving on to our third pick, we have Oracle. Oracle is one of those names that has been under pressure recently, but that very volatility creates opportunity. December saw the stock pull back, but technical support levels are holding, and there's a lot of fundamental growth potential that many investors may be overlooking. Oracle has been transforming itself from a legacy tech company into a cloud and AI powerhouse. Its cloud shift was crucial, allowing the company to integrate AI throughout its platform and position itself as a one-stop AI shop. This means clients can run applications using Oracle's infrastructure, with the flexibility to choose any AI model and even different hardware vendors like AMD, NVIDIA, or Broadcom. A key metric to watch is Oracle's remaining performance obligation, or RPO. which measures contracted revenue that has yet to be recognized. Over the last few quarters, RPO has grown by over 450%, signaling accelerating future business. This is a clear indication that Oracle's revenue trajectory is poised for growth in 2026. Some investors might ask, is this growth recurring? The answer is yes. Oracle's contracts are long-term, and as clients adopt more AI-powered solutions, the company will see renewal revenue and expansion revenue from existing clients, along with new client acquisition. So this isn't a one-time spike, it's a sustained growth story. Now, what about risk? As with any stock experiencing a turnaround, volatility is inevitable. Oracle stock may continue to swing as Wall Street recalibrates expectations. However, the downside seems limited given the fundamental strength and long-term contracts, making it an attractive buy for January, especially at current levels. For investors who are looking for a contrarian play in 2026, Oracle combines a solid cloud infrastructure backbone, AI integration, and strategic chip neutrality, which could make it a hidden gem in the AI ecosystem. Next, we turn to Apple, which is often overlooked in AI discussions. The common criticism is that Apple hasn't been aggressive in AI compared to other tech giants, but that's actually a potential catalyst in disguise. Apple has a history of quietly developing highly polished products before release. Unlike competitors who rush to be first, Apple focuses on delivering a complete user-ready experience. When Apple decides to integrate AI across its devices and services in 2026, it's likely to create significant consumer demand due to ease of adoption, reliability, and brand trust. Despite the AI weight, Apple is already performing strongly in other areas. iPhone sales remain robust, margins are high, and services revenue continues to grow. December saw Apple stock maintain strength relative to other tech names, indicating steady institutional support.
So what could be the AI trigger? Potentially, Apple's integration of AI into Siri, iCloud, and proprietary apps could drive new revenue streams, enhance ecosystem lock-in, and even provide cross-selling opportunities for devices and services. For investors, this represents a high upside scenario if Apple launches impactful AI features, while the base business continues to perform. The risk: timing is uncertain. Apple's AI developments may not launch immediately in January, and the market often prices in expectations ahead of release. But the potential payoff could be substantial, especially for investors who are patient and willing to wait for execution. Another point worth noting is Apple's consistent execution track record. Historically, Apple products don't just enter the market, they dominate it. By the time AI features roll out, Apple could leverage consumer trust and ecosystem strength to gain a competitive edge over first-mover competitors. So far, we've covered Oracle and Apple, both with compelling stories in their own right. Oracle offers a cloud infrastructure and AI integration play, supported by long-term contracts and accelerating RPO. Apple provides a consumer tech and AI catalyst story, leveraging brand strength and polished execution for potential upside in 2026. Both stocks complement the picks from Part 1, AMD and Micron, which focus more on hardware and AI infrastructure. This combination gives investors exposure across different layers of the tech ecosystem: hardware, memory, cloud services, AI applications, and consumer integration. In Part 3, we'll finish our list with Stock 5, Salesforce, breaking down its AI adoption, revenue catalysts, margin outlook, and how it fits into the larger tech and AI landscape for 2026. We'll also tie all 5 picks together and discuss overall market context, risk factors, and why January could be the ideal time to position yourself. Finally, we come to our 5th and last pick for January, Salesforce. Salesforce has long been considered a leader in cloud-based enterprise solutions, and in recent years it has emerged as a frontrunner in AI application for business automation and analytics. The company has been making significant progress with agentic AI, which allows businesses to leverage their own data alongside Salesforce's AI models to create custom applications. These applications can improve workflows, automate tasks, and deliver insights that drive operational efficiency and revenue growth. One of the key factors supporting Salesforce's growth is the company's double-digit projected CAGR over the next several years, fueled by this agentic AI adoption. For enterprise clients, this means Salesforce is not just a software vendor, they're a strategic partner helping businesses scale intelligently using AI. Margins are another reason to pay attention. Salesforce has managed to sustain profitability while investing heavily in AI and cloud expansion. For investors, this combination of revenue growth, AI adoption, and margin sustainability is particularly attractive, especially in a market where many AI plays are still unprofitable or highly speculative. Of course, there is always some volatility to consider. Salesforce has seen ups and downs tied to earnings releases and market sentiment around tech stocks. However, the recent trend shows a shift toward bullish consolidation, where the stock is stabilizing after previous corrections. This makes it an interesting entry point for investors looking for a long-term AI growth story.
Salesforce is also actively expanding its cloud footprint, which supports both recurring and incremental revenue. New client adoption, along with upselling additional services to existing clients, creates a steady growth pipeline. Unlike one-off AI experiments, Salesforce's approach embeds AI into the core operational fabric of its clients, ensuring long-term relevance and adoption. So why are these 5 picks, AMD, Micron, Oracle, Apple, and Salesforce, particularly compelling for January 2026? First, we're entering a period of opportunity. The correction in December created pullbacks across tech and AI stocks, but underlying fundamentals remain strong. Analysts continue to raise forecasts, institutions are accumulating positions, and money is flowing into AI and tech at a steady pace. For AMD, the catalyst is the MI450 launch, a game-changing data center GPU line that positions AMD as a viable competitor to NVIDIA in hyperscale solutions. Micron benefits from severe HBM memory shortages, driving high prices and strong margins across AI, cloud, automotive, and mobile markets. Oracle provides a cloud and AI infrastructure play, with growing RPO and chip neutrality creating a one-stop shop for enterprise AI solutions. Apple is a consumer tech contrarian play, with strong base business and potential AI integration poised to capture market attention. Salesforce represents AI application at scale, driving recurring revenue through enterprise adoption and agentic AI solutions. Another critical point is the market psychology. December pullbacks were partly profit-taking, but also a natural recalibration after a year of strong tech gains. Stocks like Oracle and Salesforce are down from peak levels, but sit on strong technical support, offering potential entry points. Investors who act early in January could benefit from renewed momentum and news catalysts as companies release updates, earnings, and product launches in Q1 2026. It's also worth noting that these picks cover different layers of the tech ecosystem: hardware, cloud, and enterprise software, like Oracle and Salesforce, and consumer tech, like Apple. This diversification allows investors to participate across multiple fronts of the AI and tech revolution, rather than concentrating in a single segment. Of course, no investment comes without risk. AI and tech stocks can experience high volatility, especially around earnings reports, product launches, or market sentiment shifts. For AMD and Micron, supply chain issues or competitive pressures could temporarily impact performance. Oracle and Salesforce are exposed to execution risk. Delays in AI adoption or integration could slow growth. Apple's risk lies in timing and execution. If AI rollout is slower than anticipated, there could be short-term underperformance despite strong fundamentals. However, each of these companies has a track record of execution and market leadership, which reduces the risk relative to smaller, speculative AI plays. They're not dependent on a single product or niche. Rather, their business models and product ecosystems provide multiple growth levers. For investors, this balance of upside potential with measured risk makes these 5 stocks highly appealing as we enter the new year. From a broader perspective, January 2026 represents a strategic window for positioning. Early year inflows, combined with market recalibration after December corrections, could generate significant price momentum. This is particularly relevant for AI and tech stocks that have strong earnings visibility, product catalysts, and institutional interest. By focusing on these 5 picks, investors gain exposure to high-growth areas without over-concentrating in speculative sectors. So, to recap, our top 5 hot stocks for January 2026 are AMD, hyperscale GPU launch, positioning it against NVIDIA; Micron, high-demand HBM memory and strong earnings outlook; Oracle, cloud and AI integration with long-term contract visibility; Apple, consumer tech with potential AI catalysts and execution excellence; Salesforce, enterprise AI adoption through agentic AI solutions. Together, these stocks provide exposure across hardware, cloud, enterprise software, and consumer tech, offering diversified access to the AI and tech growth story in 2026. The key takeaway? December weakness doesn't signal the end of the AI trade. It may actually represent a buying opportunity for the year ahead. Stay tuned, follow these catalysts, and keep an eye on technical support levels and news events in the coming weeks. By strategically positioning in these companies now, investors may set themselves up for strong upside potential throughout the first half of 2026 and beyond.